Hello, my name is Shane Obata, and I'm the lead portfolio manager on our Innovation Dividend Fund. Ticker on the TSX is MINN. Just wanted to give you a quick update for the end of February. Here is a disclaimer, which you can read at your leisure. And then a little bit of background on the company. We are an equity income-focused active manager, private and independent, which I think is really important in this day and age. And then, of course, we've been around since 1979. We've become a trusted partner to professionals in Canada as well as in the UK. So in terms of what we're all about, active management is key. We think that superior security selection and asset allocation are critical for delivering superior returns over time. And as I mentioned before, we have an equity income focus. We do dividends, we think a little bit differently. We have portfolios with high active share, but the portfolios are still concentrated, but not too concentrated so that we get both diversification benefits as well as the ability to make meaningful returns on our highest conviction names. And we have various strategies, as you can see here. We have 6 distinct sleeves, I would call them. And today we're going to focus on the innovation sector. Just some background information here. I already mentioned the ETF with the ticker MINN. We've had a good year thus far, and we're expecting the market to remain cooperative throughout the end of the year. There's also a mutual fund, the Innovation Dividend class, if you're interested in that as well. So getting into the overview, I think it's reasonable to say that every investor needs more tech. Technology beats the market over time. And that's why in our chart here, we've said, don't trade tech, own it for the long run. As we all know, tech can have higher volatility than the broader market, but over time, it's performed exceptionally well. And it's important to note that this has been grounded by EPS growth. Well, valuations are typically higher for technology stocks. Again, we have to think about EPS growth. And oftentimes with technology companies that start small and they grow quickly, maybe their earnings are small in the beginning, but there's a lot of potential for growth. So EPS growth is very important for technology stocks. And it's a fundamental underpinning for the performance that we've seen. The other thing I would say is that modern innovation is centered in technology. PCs, internet, mobile, cloud, and now AI. It's all technology, right? And we've been hearing a lot about different AI plays in different sectors. And I won't get into that right now, but let's just understand that a lot of what's driving innovation in other sectors is coming from technology again. So tech is immersive, it's everywhere, and it's unsurprising that we see these secular trends develop, mega trends develop in the technology sector. And then just to reiterate, own tech, don't trade it. It's difficult to trade. It's long cycles, but patient investors can get rewarded very handsomely. Other reasons to own more tech. These are really, when we think about the M7 stocks, or at least most of them for an example, these are the new consumer staples. This is something we've been saying internally for years. What do we mean by that? Well, I'm not telling you that Kleenex and toilet paper and toothpaste and paper towels aren't consumer staples. They are. We need them in our day-to-day lives. But if we think about how often we interact with our phones and computers on a daily basis, we are so much more dependent on these things in day-to-day life than we are conventional staples. So I think that is very true from a time spent perspective. Tech is also naturally diversified by geography and industry, while some that will vary by company. However, that diversification provides some resilience, because if there's weakness in one area, there may not be weakness in another area. And then tech is highly adaptable. Tech companies are able to pivot quickly and change to meet the evolving needs of consumers. So I think that is important. What other sector can adapt more than tech, faster than tech? Should you add now? I think the answer is yes. So Jensen Huang, who we know as the godfather of AI, he said ChatGPT is the iPhone moment of AI. Now, we can debate around that, but we're very positive on AI. We're seeing tangible evidence that investment is going to continue. And more importantly, there are early indications around return on investment for those adopting it, which is very important. But I think investors have missed and continue to miss out on this new tech bull market. We are in a bull market, and we're only technically in the second calendar year of the AI cycle. So if we use the internet analogy, then there are multiple years left in this spending cycle. And I would again come back to the fundamental underpinnings here. Why should you add now? Because there's above market EPS growth in the technology sector. And we would actually say there's upside to these estimates too, because while there has been strength in AI related industries, there has been weakness in other areas. So for example, the PC and smartphone markets, which are huge markets, are just emerging from a long and drawn out post-COVID hangover period. And so as those and other cyclical industries bottom, there's a good potential again for EPS upgrades to this sector. Now, of course, we want to mention the negatives. Valuations have expanded. There's no doubt about that. Regulation is always something on our minds as tech investors, and geopolitics, it's important to consider too, because the global supply chain is linked. And so there are key relationships and points that we always need to consider. Why our ETF? I think our ETF is a great vehicle for investors that want high quality exposure to technology. We are going to give you access to mostly large cap companies that are established, and we've had good success with the early leaders in AI, and we think that we have the ability to find companies that will emerge as the new leaders, the next generation of leaders in this area. Another important point to mention back to why MINN, we're entering the golden age for tech dividends. Now, historically, you could have made the argument that, especially in tech, when companies start paying dividends, it means they don't have other investment opportunities. In other words, they are no longer innovative and they are paying shareholders handsomely to stay involved in their companies. However, I think that's changing now. We've seen what happened with Meta, and Meta is a great example because we think they're going to pay dividends and grow dividends, but they're not sacrificing their innovation. They've just determined that they can do both. So I think the idea that dividends means less innovation does not hold. And I think we'll see more of this coming down the pipe soon. Another reason why you should consider MINN is because, again, coming back to that high quality tilt. Coming into this year, we thought that even if rate cuts had materialized by now, lower quality junky companies, and by that I mean highly leveraged, not yet profitable, et cetera, would still have trouble in this rate environment because rates are still much higher than they were in the pre-COVID period. And that this kind of environment bodes well for bigger companies. Here is a look at our performance, and we're very pleased with the end of February numbers that you can see here. You can pause and take a closer look if you want, or you can also check us out on Morningstar. This is what I think is a great case study, kind of looking at our fund like it's a stock. And we've bucketed these metrics into two areas. One is GARP and the other one is quality. And when we compare our fund to the S&P 500, for example, if you were to look at just the forward PE of our companies, perhaps you would say, okay, this is too expensive. But as growth investors, we are looking for EPS growth, as I mentioned previously. And so you can see that on a PEG ratio, we are actually less expensive than the S&P 500. And I think that's a key way to look at technology stocks. In terms of quality, you can see margins, profitability, and a balance sheet metric here. These are all components of what we would consider high quality, and you can see that we are well positioned in those areas. When it comes to our investment process, I think it's important to have these overarching secular megatrends. And the first, and maybe arguably the most important one, is tech ecosystems, right? What do I mean by tech ecosystems? If we think of Apple and Google as two great case studies, they have so many users and so many devices and so many interrelated products and services. And as these networks grow, the value of those networks for the users becomes higher. And that's so important because these networks are very difficult to replicate. So the companies that have already scaled up are benefiting from them and will continue to benefit from them as they sell new products into their existing channels. The cloud migration is still important. We've seen a reacceleration in cloud growth recently, which is important. This really drives a lot of the market, and I wouldn't say necessarily we're in the first inning, but we're nowhere near the last inning of the cloud migration. A lot of businesses are still running private infrastructure or hybrid infrastructure, and I do think there will be a need for all of the above, but the cloud migration continues. You can see it in the cloud service provider numbers. The other thing is the growing semiconductor market. I mean, even before artificial intelligence, we were excited by the growing content in electric vehicles, for example. But the bottom line is that semiconductors are being used everywhere and in everything. So we have high confidence that this market is going to continue growing nicely through the end of the decade, and especially with AI, especially when we consider AI. Productivity gains through software, another important thematic, and we're seeing it. Actually, we are starting to see productivity increase, and that's been something that's been lacking in the US economy, for example. So that is really positive. And this really means getting more output at a lower cost from your people. And that's, again, coming back to why technology is so important. Cybersecurity, also important. I swear we see a new hack every week, every 2 weeks. It's continuous. And so because the threat landscape is always evolving, you need to continue investing. You need to do your best to protect your business, your data, your customer data, et cetera. So it is totally critical in the modern age to continue investing in cybersecurity. In terms of top stock picks, these are all names that we've liked for a while. Broadcom is, and this may not be very well known, at least not as well known as Nvidia, but they are the number 2 player in dollar terms in AI semiconductors. And that's part of a broader business. They've shifted a little bit more towards software. They also have exposure into other markets, more consumer-facing markets, telecom, et cetera. But we are most excited about their AI capabilities, and these come mainly from custom chips, but also from data center networking capabilities, solutions, I should say. Great company, definitely one that we continue to like for the long term. Google, a name that we've liked for a very long time. You can make the argument that the market is giving negative value to Google for their AI capabilities, and that just seems totally crazy to us, really, because this stock is trading at a discount to the S&P 500. It's trading at a massive discount to its peers in the M7. And we're talking about a company that has some of the best research capabilities in the world, some of the best consumer data in the world, some of the best AI infrastructure in the world, And you can make the argument that it's number one in some, if not all of those areas. So we just think the market has got this wrong on Google's AI capabilities. They've had some missteps recently, but we think they're going to rectify them. Palo Alto Networks has been our top pick in cybersecurity. And this is really just a name that we have high confidence in can benefit from vendor consolidation as they continue to provide various solutions to companies that need cybersecurity. That is to say, historically, there have been a couple different components of cybersecurity, and perhaps you would get each one from a different vendor. While we think that the idea of vendor consolidation makes a lot of sense in a lot of different areas, but especially here, if you can get all your solutions from one company, why wouldn't you? And this is a real business. It's profitable. It's in the S&P 500 now. It's consistently profitable. So we still think it provides nice GARP value in what is often an expensive industry, and GARP is growth at a reasonable price. In summary, we think investors should increase their allocation to tech and specifically to our ETF, which I've mentioned it's a high quality fund. It provides dividends for our investors, and it's well positioned for the current environment, and you can see that through our performance. And again, it's important to remember that tech outperformance is grounded in fundamentals. This is not the internet bubble again. There are real earnings, real established businesses with real earnings right now putting out amazing numbers. So I think that's an important distinction to make because there's a lot of fear mongering going on out there. And then finally, the AI cycle, I think there's a lot of opportunities. The opportunity set is broadening. And it's important to note our top two contributors in 2021 were AI exposed stocks outside of the M7. So there's other ways to win than just investing in the names that we all know the best. And we think we've proven our ability to identify those. We'll skip the appendix, but if you want to pause and take a look at some of this on our investment process and our summary, then by all means. Okay, well, thank you for joining me today, and have a great rest of the week.